Investors are nervous, regulators are getting tough, markets are volatile, and interest rates are next to nothing. So how are you supposed to invest in this environment?
Good question.
Many have piled into ETFs, but are they really better than mutual funds? Many of the sharpest financial advisors around are meeting to discuss just that and where to put your money to work. Joining us live from the Schwab Impact Investing Conference in Boston, we have Tom Lydon, editor of ETF Trends, Peter Crawford, Senior Vice President of Schwab ETFs. Tom Lydon, I just want to go to you before we get into the debate with mutual funds. Today may be a big turnaround day. The Fed's easing may come in much lighter than people expect. There's a run into the dollar, out of gold and commodities, and out of stocks. Now, as an ETF man, do you switch your strategy very much, or do you stay with it for the longer term?
Well, Larry, you know, I mean, we've got this nice trend in equities right now. I think the average investor is feeling more confident, and confidence is key. And as you talk to the thousands of investors and advisors that are here at this conference, they are much more optimistic than they've been in many, many months. So I think you can't fight the trend. Things are in place. Equities are attracting more and more money, not only domestically, but also into foreign markets. And I think that trend's going to continue into the next year.
Peter, okay, let's get to this ETF versus mutual fund issue. Peter, you think there's a lot of winning traits when it comes to ETFs. Explain what those are and how you believe they're actually more beneficial to investors than your typical mutual fund.
So ETFs are exchange-traded funds, which means it's a mutual fund that trades like a stock on an exchange. And what's great about ETFs is they appeal to two very different types of investors. For the very active traders, what they like about it is that liquidity, that ability to trade it throughout the day, which means they can also short it, they can buy it on margin, and they have that instant liquidity, if you will. For the more buy and hold investors, a very different type of investor, what they like about the ETFs is they tend to be lower cost than your mutual funds, particularly your actively managed mutual funds, but they're also more tax efficient, which means they pay less in the way of capital gains distributions than you might get in a typical mutual fund. So very, very different types of clients, but they've appealed to both.
Tom Lydon, talk to me about the tax efficiency that Peter just mentioned. A lot of people worried about year-end taxes, the disposition of capital gains and dividends. Tell me about tax efficiency in ETFs.
Well, because most ETFs are index-based, there's very low turnover. And Larry, you know exactly what you're buying. And with low turnover and the structure of ETFs, there's very few, if any, distributions. We saw in the last couple of years with the declines in the market, actively managed mutual funds, even though they were giving back gains that they made in the prior years, were also kicking off huge distributions, adding insult to injury at the end of the year. So just another reason to consider ETFs. And as you ask the advisors here today, it's one of the most innovative products that you've seen in decades.
Okay, but what's the downside here? They are incredibly popular, but Tom, can I still capture the kind of upside that I might be able to capture in a mutual fund that's run by a really terrific manager?
Well, the question is, how many real terrific managers are out there? 7 out of 10 underperform their benchmarks. But picking your spots is key, and that's something in this market environment is more important than ever. So finding those areas that are trending in the right direction. Recently, we've seen the boom in commodities. ETFs give that many more opportunities. Currencies are an asset class that really weren't available within mutual funds. So here's some areas where you may be able to hedge your portfolio or even help provide that alpha that people are looking for.
Peter, what's the difference between expenses for ETFs and mutual funds?
Well, the ETF expenses, so the ETFs, the vast majority of ETFs are passively managed, which means they're going to have lower expenses anyway. But you can get ETFs now, and we have an ETF, for example, that has as low as 6 basis points of an ongoing expense ratio. So that's 6 cents per $100 invested. Many actively managed mutual funds will be 100 to 120 basis points, or 1 to 1.2%. So a huge difference, and that's more money to work for you in the market. And that really adds up over time.
So on top of that, Larry,
no, go ahead, Tom. Go ahead.
On top of that, it's important to know, and Peter didn't mention, these ETFs that Schwab offers, if you buy and sell them at Charles Schwab, you don't have to pay a commission. So we're starting to see this innovation in pricing get better and better for the average investor. And 25%
so it really involves taking
of
some
all
ownership too, right? I mean, Tom, Peter, this is about people taking responsibility for their own portfolios and really being much more active in some ways, right?
Well, not necessarily. You can still be very much a buy and hold investor. Get your asset allocation through your ETF exposure. Buy large cap, small cap, emerging markets, international.
But you're not relying on a fund manager. You're relying on your own sector picks.
Well, you're relying on your asset allocation, and there's plenty of studies that say that the vast majority of your returns are really determined by your asset allocation. What you're saying is, I'm not going to try to beat the market. I'm going to try to get market returns, and over time, that's going to be good enough.
Tom, last one. I mean, look, so everybody should just buy ETFs and sell mutual funds.
I'm going to say.
But there's a very large mutual fund industry out there. Very, very large. I mean, the mutual fund guy would probably say, we own the same indexes, but we give you more advice, we give you research, we hold your hand. If you're in ETFs, you're just off there by your little self. I mean, what's the answer to those kinds of things? Why do you love ETFs and none that don't love mutual funds?
Well, Larry, the bottom line, it comes down to performance. And if you're paying above average expense ratios and you're underperforming, today investors after the last 10 years are fed up. So they're rolling up their sleeves, they're getting more involved, and if they can save 1% annually expenses and not beat the benchmark, but get the benchmark, they're going to perform better over time. So it's a great option, it's a great tool, and going forward, investors are more concerned about retirement, so that's why they're selecting ETFs.
But I'd also say...
Final word, Peter.
Well, I would just say I don't think it's an either or. We're certainly seeing plenty of flows, plenty of money going into actively managed mutual funds as well as ETFs. So at Schwab, we have $500 billion in mutual funds, $100 billion in ETFs. Clients want both. They want to combine those in their portfolio. So we see an opportunity for both of them, and we want to make sure they can avail themselves of all those opportunities.
Okay, thank you so much, Tom. Peter.